The WorldCom scandal is about a US telecommunications company, and they provided phone and mobile services. So this is a big company. You can see the revenues leading up to the scandal in 2002 have been going up. So if we look at them in US million dollars, it went from 4,449 to over 7,000 to 17,000, so over doubled, and then doubled again, and then stayed at that high level and plateaued and actually decreased a little bit in 2001. But this is a big company growing at a really rapid rate with a lot of new customers and a lot of revenues. So the big thing when you're a telecommunications company, the major expense is line costs. And what that is WorldCom might provide services to customers, so phone plans and so on, like Telstra does here, but they might not own all the cables and towers that exist in the country. So to get mobile service to everyone, companies need to have infrastructure. Well, WorldCom wasn't that company, so what they would do is they would effectively rent it from the people who owned all the cables and towers. So you would pay them, and then you would sign up your customers, and your customers would give the money to WorldCom. So basically, line costs seem to be a really big expense for any telecommunications business. You need to hire the cables and towers in order to generate your revenue from your customers. And this whole case study is about the close link between assets and expenses. So let's look at the definition of each. An asset is a resource controlled by the entity as a result of a past event from which a future economic benefit is expected to flow to the entity. Looking at an expense, that's an outflow of economic benefits that will either decrease assets or increase liabilities, and it has the ultimate effect of decreasing owner's equity. So what is the link between these two? Well, it's all to do with the economic benefits. So you can see the asset says it's something that will provide a future economic benefit, whereas an expense is an outflow of economic benefits. So essentially, an asset is when the economic benefit has been consumed in the future. You haven't used it yet. The economic benefit will be used up in the future. That's an asset. And an expense is when the economic benefit has actually been consumed or used up. So once an asset's been used up, its economic benefits, essentially it becomes an expense. So providing a really basic example, we're not going to use a residual value or useful life or anything here. We're just going to assume a company had a $20,000 delivery truck and it's going to use it for 4 years. So at the start, there's $20,000 of economic benefits with that truck that haven't been used up, so that's an asset. And because none of the truck's been used yet, expenses will be zero. Now after a year, when the truck's been used for 1/4 of its life, there's $15,000 of assets left because $5,000 of economic benefits have been used up. Similarly, after the second year, we've now got $10,000 of economic benefits that haven't been used up. They'll be used up in years 3 and 4. And $10,000 of expenses or economic benefits have been used up. Year 3, we're left with only $5,000 of asset left for the future, but $15,000 of expenses have been used up. And then by the end, we'll see that there's no asset left and the whole amount has been used up. There's no more economic benefits in the future. The truck has all been consumed. Its economic benefits have been used up. So what about these line costs? Well, WorldCom have been actually treating these line costs as an asset. So let's go through our definition. So they're hiring cables and towers to use from other companies in order for them to provide mobile phone services to customers. Is that a resource controlled by the entity? Well, it's a bit debatable. I guess we could say yes, because once we've paid the company to use their services, we're entitled to use it however we want, so we kind of control that asset. So we could argue that that's true. Is there a past event? Well, there was. They would have paid the cables and towers company money for the privilege of using their facilities, so that's true. But will there be a future economic benefit? And we're going to say that one's not true. When you think about it, when you look at WorldCom hiring to pay all those mobile phone towers, they're doing it this year so that they can earn revenue from customers this year. So essentially, all that rental of the cables and towers has been used up in 1 year in order to generate the revenue of that year. So when we're talking about is it an asset or an expense, we're going to have to say that's an expense. We used up our line rental and our infrastructure, our cables and towers fees, and we used it up in order to sell mobile phones to our customers. So in June 2012, actually June 22, 2002, that should say, WorldCom announced that they had overstated net profits by $3.8 billion for the previous year and a little bit of 2002 because $3.8 billion of line costs have been wrongly treated as an asset instead of an expense. So let's look at the impact here, and let's look at the incorrect treatment on the left and the correct treatment on the right, and take a very basic accounting equation. Let's just assume that the company had $100 billion of assets, $30 billion of liabilities, and $70 billion of owner's equity. So these are just made up numbers. So let's say this was treated as an asset. So they paid the Cables and Towers company $3.8 billion to use their services, so their cash went down. However, what they're saying is they were treating that as an asset. So they had an asset called line cost rental, or prepaid line cost rental, going up by 3.8 billion. And the impact there is assets actually stay the same. They went down and up by the same amount. There's no impact on liabilities, and owners' equities had no impact either. We didn't call it an expense. Now, if they had correctly treated it as an expense, here's what would have happened. They would have spent the money to pay the Cables and Towers company. That's a decrease of 3.8 billion, but it should have been called an expense. Now, what does an expense do? By definition, it decreases owner's equity or capital. So what really should have happened is assets should have gone down to 96.2, liabilities would have stayed the same, but owner's equity should have gone down to 66.2. So now when we compare the two accounting equations, the incorrect or the fraudulent treatment they did, they've got assets of 100. Really, assets should only be 96.2. Assets were overstated. Liabilities don't matter. No matter how that line cost was treated, our liabilities still would have been 30. But lastly, owner's equity would be overstated. That's because they incorrectly called it line cost an asset. So owner's equity didn't change, when really it should have gone down to $66.2 billion. So what's the motivation? Why would a company that's growing so big and such a big, obvious, global, actually a national company in America that everyone's heard of, why would they do this, and how did they think they could get away with it? Well, it was out of desperation. We showed them making lots of revenues, but they weren't a profitable company. In fact, they made a loss in 1996, a very small profit in 1997, another loss in 1998, small profit in 1999, a huge loss in 2000, and a huge loss in 2001. So I guess the motivation would be, well, if we're going to call line costs an asset, that way we're not going to have any expenses. If we don't have expenses, our profits will be better. So that's the motivation. A lot of the executives that work there, they had shares in the company. They wanted the share price to look good. So the share price looks good when your profits are good. So that's why they were motivated to perform this fraud. So let's have a look at the impact once it was discovered in 2002. You can see the share price fell away, and in fact it fell away to basically zero because the company filed for bankruptcy. And at the time they had $107 billion of assets, so it was the largest bankruptcy in US history at that point. That's since been passed by Madoff and some of the banks. It ended up being bought out by MCI Inc., which today is called Verizon. So you might have dealt with a mobile phone company in America if you've roamed when you've traveled, and Verizon is one of those companies. Well, they bought WorldCom, so WorldCom's now that company. And remarkably, the CEO, who was in charge of this fraud, actually got a 25-year prison sentence. They're really tough on white-collar crime in America. And this wasn't the only fraud that was committed. He did a lot of other things, but this was a part of it. And in total, he got a 25-year prison sentence. So let's look at some questions to answer. Do you know how to define an asset and an expense? That's vital for Year 12 accounting. Similarly, I think you want to look, well, how are assets and expenses different? So, and by doing that, I think you probably want to also look at, well, how are they similar? What was the similar connection? We said there's a bit of a link to them, but that also reveals another difference, and it's all to do with the economic benefits. What was the motivation for WorldCom classifying the line cost as an asset? Why were they doing that? All to do with how their net profits have been in the lead-up years, which wasn't good. And lastly, what was the impact on WorldCom's financial statements as a result of the fraud? Profits were too high, assets were too high, and so on. And if you can understand that, you're going to be able to apply that knowledge to our much easier and simpler to understand problems in Year 12 accounting.